The real estate landscape in 2025 is shaped by technological advancements, sustainability, and demographic shifts. Key trends include the rise of smart cities, increased demand for green buildings, and the impact of remote work on urban planning. Investors and developers must adapt to these changes to remain competitive and meet evolving consumer expectations.
The real estate landscape in 2025 is shaped by evolving trends, including demographic shifts, technological advancements, and economic cycles. Key areas of focus include industrial smart growth, data centers, and senior housing. Understanding these trends is crucial for stakeholders to navigate the complexities of the market and capitalize on emerging opportunities. Chapter 1: The Time Has Come explores pivotal shifts in real estate, highlighting the onset of a new cycle and a building boom benefiting tenants. It delves into demographic impacts and the challenges of extreme cold, while addressing the complexities of property technology's influence. These trends set the stage for understanding the evolving landscape of real estate in 2025. The editorial leadership team for Emerging Trends in Real Estate, registered trademark 2025, includes Andrew Alperstein and Angela Kane as chairs, with Chuck DeRocco and Anita Kramer as editors-in-chief. Chapter authors include Andrew J. Nelson, Garrick Brown, and Leslie Deutsch, among others. Contributors and advisors from PricewaterhouseCoopers and the Urban Land Institute ensure comprehensive insights into real estate trends. Emerging Trends in Real Estate 2025, a collaboration between PwC and the Urban Land Institute, offers insights into real estate investment, development trends, finance, and capital markets across the United States and Canada. The report is based on surveys and interviews with over 450 industry experts, including investors, developers, and advisors, providing a comprehensive outlook on the sector. The 2025 edition of Emerging Trends in Real Estate highlights key insights from industry experts. It reflects a comprehensive analysis of real estate investment, development trends, finance, and capital markets across the United States and Canada. The report is based on extensive surveys and interviews with over 2,000 professionals, offering a diverse perspective on the evolving landscape of the real estate sector. The commercial real estate market is poised for recovery as the Federal Reserve signals a shift in policy, reducing the federal funds rate by 50 basis points. This move, anticipated by industry experts, marks the beginning of a new expansionary phase. With financing costs expected to decrease, the market is set for growth over the next few years. The commercial real estate landscape is evolving, with optimism growing as profit expectations rise. Survey results show a significant increase in firms anticipating good or excellent profits, up from 41% to 65%. However, the industry remains cautious, acknowledging a new interest rate regime influenced by demographic shifts and exhausted cheap labor, marking a shift from pandemic-driven changes to cyclical market dynamics. New supply is outpacing tenant absorption, raising concerns about sustained demand. Lower interest rates, while beneficial, signal economic slowdown, challenging refinancing. Investors see opportunity with low prices, yet some await more transactions to confirm pricing. Market recovery is expected to be gradual, with optimism for stronger performance in 2026 and beyond. Interest rates are finally decreasing, but this shift comes with challenges. The real estate industry, accustomed to cheap credit, faces a new reality. The Federal Reserve's rate hikes, starting in 2022, caused panic, drying up transactions. Although concerns have eased, interest rates remain a top issue. The recent rate cut offers psychological relief, signaling a potential pivot in economic strategy. Commercial real estate thrives on low-cost debt, but interest rates reflect broader economic conditions. Despite rate cuts, the economy remains strong, with gross domestic product growing at 2.4% and robust job creation. However, financial markets hint at slower growth, affecting tenant demand and commercial real estate asset prices. The Federal Reserve's policy shift offers more certainty, encouraging market activity. Real estate capital markets are showing signs of recovery, liquidity is improving, and capitalization rates are stabilizing. The Federal Reserve's clear guidance aids price discovery, reducing bid-ask spreads. More investors are engaging in transactions, though development remains cautious. Despite uncertainties, consensus on financial metrics is growing, enabling market clearance and transaction activity to find a new equilibrium. Real estate capital markets are in early recovery, with improving liquidity and tighter pricing. The Federal Reserve's guidance aids price discovery, reducing bid-ask spreads. Debt costs are lower, enhancing deal economics. While commercial real estate debt markets remain undersupplied, lending is increasing, with a 2% rise in 2024. The Mortgage Bankers Association forecasts a 26% rise in originations, nearing pre-pandemic levels. Sales in the first half of 2024 were a third lower than the 2015 to 2019 average, with all major property types affected. Industrial sales fell 4% below pre-pandemic levels, while office sales plummeted over 60%. Despite this, industry optimism is growing, with expectations of returning to 2018 to 2019 transaction levels by 2025 to 2026. Commercial real estate prices have dropped over 20% since their peak, with core sectors like office and retail hit hardest. Office values are down by a third, while multifamily and hotels have seen smaller declines. Despite this, market sentiment is cautiously optimistic, with capitalization rates decreasing, suggesting a gradual recovery in asset values, though not to pre-pandemic levels. The looming $1.2 trillion debt maturities in commercial real estate, especially in the office sector, are not causing widespread concern. Many debts are being extended, with prices recovering and interest rates declining. Delinquencies remain low, but distress is expected as interest rates align with economic realities. Liquidity returning to commercial real estate markets suggests an impending upturn in the real estate cycle. The pandemic reshaped tenant space usage, with office workers commuting less and online shopping increasing. Demand for space has rebounded, surpassing pre-pandemic levels, yet vacancy rates rise as new construction outpaces absorption. Tenants leverage this to negotiate better terms or upgrade to higher quality spaces, widening the gap between newer and older buildings. Retail continues to see a divide, with necessity retail thriving. The industrial sector is experiencing a bifurcation trend, similar to the office sector. A surge in online shopping led to a shortage of warehouse space, prompting record construction. Over 1 billion square feet of new space was added, but demand hasn't kept pace, increasing vacancy rates. Tenants now seek modern features and strategic locations, emphasizing productivity and proximity to metro areas. The multifamily sector is experiencing a temporary oversupply, with construction slowing and projects dwindling. Despite this, housing remains undersupplied nationally, especially at affordable price points. Data centers face a supply shortfall due to power constraints, while life science facilities are overbuilt, particularly in secondary locations, yet long-term prospects remain strong due to demographic and technological factors. The United States is witnessing a transformation in migration patterns. Cities like Orlando and Austin are seeing reduced in-migration, while unexpected areas such as Minneapolis and Boise are gaining popularity. These shifts could significantly impact real estate markets, presenting both opportunities and challenges for developers and investors as demographics steer future trends. The rise of remote work has led 35 million Americans to embrace suburban and exurban living. This shift has resulted in 30% of households moving to different cities and 13% to new states. Consequently, mixed-use suburban communities are emerging, offering urban amenities in suburban settings, appealing to remote workers seeking flexibility and quality of life. The rise of remote work has transformed suburban living, with 35 million Americans now working from home part-time. This shift has led to the growth of suburban communities, blending suburban space with urban amenities. These areas cater to remote workers seeking professional flexibility and quality of life, driving significant demographic and real estate changes. International immigration is now the primary driver of United States population growth, accounting for 75% of the increase in the 2020s. This shift is crucial as it offsets the lower birth rate, preventing labor shortages. With immigration, the United States working-age population could grow by over 10 million, boosting real estate demand and stabilizing construction costs. John Burns Research and Consulting LLC highlights the critical role of immigration in sustaining United States real estate growth. With a projected increase of over 10 million in the working-age population, demand for residential and commercial properties is set to rise. This influx helps mitigate labor shortages, stabilizing construction costs, and supporting economic expansion. John Burns Research and Consulting highlights that the time has come for significant shifts in real estate. The focus is on evolving migration patterns, with a notable movement from colder regions to the Sun Belt. These changes are driven by factors like climate, housing affordability, and quality of life, reshaping the real estate landscape. The pandemic reshaped property markets, prompting shifts in tenant space demands and migration from central cities to suburban areas. While Sunbelt migration continues, it's moderating due to climate change, housing affordability, and quality of life. Interstate migration is declining, with apartment renewal rates rising due to high home prices and increased remote work options. Migration patterns are shifting due to climate change and cost of living adjustments. Sunbelt areas, once attractive for affordability, are losing appeal as costs rise. Climate concerns are increasingly influencing relocation decisions, with younger demographics particularly affected. Evidence suggests climate change is impacting domestic migration, slowing movement to traditionally fast-growing markets. Climate migration patterns are shifting as climate impacts and costs rise. The National Oceanic and Atmospheric Administration reports increasing billion-dollar climate events. Hurricane Helene showed no place is climate-proof, with 45% of United States homes at risk from severe climate threats. Insurance costs are soaring, affecting both residential and commercial properties, influencing migration decisions. Extreme cold events, like Winter Storm Uri in Texas, are increasingly impacting regions unaccustomed to such conditions. Uri caused over $30 billion in damage, highlighting vulnerabilities in infrastructure. Experts suggest Arctic warming destabilizes the jet stream, leading to more frequent cold snaps. This poses significant risks for buildings in traditionally warm climates, necessitating updated resilience strategies. Buildings in traditionally warm regions face increased risks from extreme cold due to outdated building codes. Energy grids are vulnerable, leading to outages. Developers are integrating climate risk into strategies, focusing on infrastructure vulnerability. Mitigation includes upgrading insulation, providing backup power, and installing freeze protection. These measures aim to minimize damage and ensure business continuity. Housing costs and availability have resurfaced as the top social issue, surpassing political extremism and immigration policy. The national housing affordability crisis has intensified, becoming a key topic in the United States presidential election. Despite increased attention, solutions remain elusive, with home prices 50% higher than pre-pandemic levels and mortgage rates still elevated. The Federal Reserve's high interest rates have stalled the home resale market, reducing inventory and driving prices up. Construction costs have risen, discouraging new builds, while the Federal Reserve's reliance on outdated inflation metrics has prolonged affordability issues. Despite a rise in homeownership rates, many households remain renters due to high purchase costs. Rents are declining due to a surge in new supply, yet nearly half of renters remain cost-burdened, spending over 30% of income on rent. Building more housing is crucial to affordability. Minneapolis and St. Paul illustrate contrasting strategies. Minneapolis increased housing density, while St. Paul increased housing affordability. Paul relied on rent control, resulting in differing impacts on housing production and rent growth. Accessory dwelling units, ADUs, and smaller homes are expanding affordable housing options. Accessory dwelling units, separate from main houses, offer additional living spaces. The trend towards smaller homes continues, with median sizes decreasing. However, high permitting costs push developers towards larger homes. Addressing housing affordability requires national strategies, as shortages affect nearly every metro area, demanding collective action and policy innovation. The Global PropTech Confidence Index shows a resurgence in industry sentiment, with 77% of investors planning to maintain or increase PropTech investments. Mergers and acquisitions remain strong, with 87% expecting steady or increased activity. Key trends include artificial intelligence applications in real estate, environmental, social, and governance alignment with regulations, and ongoing PropTech innovation reshaping the industry. The residential real estate market is under scrutiny, with a focus on commission structures. New regulations require buyers to negotiate agent payments upfront, potentially reducing agent involvement. A lawsuit against a PropTech giant highlights concerns over rent-inflating algorithms. These changes may drive innovation in technology solutions, streamlining the home buying process and reducing reliance on traditional agents. The commercial real estate industry faces heightened uncertainty due to geopolitical risks and the upcoming United States election. Conflicts in Ukraine and the Middle East could impact global trade and inflation. A split government is expected, affecting policies on immigration, regulation, and climate change. The Tax Cuts and Jobs Act's expiration in 2025 adds further complexity for real estate investors. The real estate industry faces significant uncertainty due to geopolitical tensions and upcoming United States elections. Concerns include potential impacts on global trade, petroleum prices, and economic stability. A split government may hinder policy implementation, affecting immigration, regulation, and monetary policy. The expiration of the Tax Cuts and Jobs Act in 2025 adds further complexity, influencing tax consequences for real estate investors. Industry leaders are cautiously optimistic, focusing on stability as property markets stabilize post-pandemic. The rise in data center demand, driven by artificial intelligence expansion, highlights a shift towards niche property types. Core sectors like industrial, single-family, and multifamily housing show slight rating changes, reflecting long-term demand strength and cyclical issues like oversupply and interest rates. Hotels and retail sectors have shown significant upward movement, reaching their highest ratings since before the pandemic. Retail benefits from limited construction, while office spaces, despite being the lowest rated, have improved the most. Non-core subsectors like data centers, senior housing, and shopping centers are outperforming core sectors, highlighting their growing importance in the market. Industrial real estate is evolving with smart growth strategies, emphasizing asset selection and infrastructure needs like power and automation. Supply chain diversification through nearshoring and onshoring is crucial for location choices. As companies navigate economic uncertainty, strategic leasing decisions are shaping future growth, optimizing costs, and enhancing supply chain resilience. The industrial development cycle is rebalancing, with new construction starts falling by 43% in early 2024 and projected to decline further by 20% in 2025. Developers are adopting disciplined approaches, offering high-quality facilities, especially in the Sun Belt. Supply chain diversification is crucial, with increased real estate expansions in Mexico and India to mitigate risks and enhance proximity to consumers. Power availability is crucial in leasing decisions, second only to location. In high-demand areas like California, power shortages hinder operations. Modern logistics facilities require advanced power solutions, including battery and solar capabilities. Technology and automation enhance supply chain efficiency, with artificial intelligence optimizing warehouse operations. Sustainability is vital, with 40% of industrial users adopting net zero goals by 2024. Industrial investment is stabilizing as investors adapt to new capital costs. Deal volumes are steady, with Los Angeles seeing declines and Dallas experiencing growth. Cross-border investors favor portfolio deals, viewing industrial real estate as a stable asset with strong income growth prospects, high operating margins, and low capital expenditure needs. Data centers are rapidly expanding due to surging demand from artificial intelligence, cloud storage, and mobile data traffic. However, power constraints limit new supply, leading to high rents and profits. Challenges include electricity needs prolonging coal use, cooling requirements, and potential legislative hurdles. Despite these, data centers are poised for growth, driven by artificial intelligence's economic and societal benefits. Data centers are categorized into enterprise, cloud, and multi-tenant facilities. Cloud facilities support scalable applications like artificial intelligence, while multi-tenant centers enhance interconnectivity. Northern Virginia leads due to fiber connectivity and low disaster risk. Risks include technological obsolescence and power constraints. Environmental impacts are significant, prompting exploration of clean energy solutions. Data centers are poised for significant growth, with global capacity expected to double in 5 years, requiring $188 billion in investment. Institutional investors are keen, with 97% planning increased allocations. Despite power procurement challenges, data centers remain highly profitable, with long leases and credit tenants supporting high loan-to-value ratios, ensuring quick lease-ups at premium rates. The senior housing sector must innovate to meet the growing demand from the aging population, particularly the baby boomers. With the population of those aged 80 and older outpacing inventory growth, developers should focus on aligning projects with consumer preferences and market trends. Despite reduced development activity, this is an opportunity to strategically position for future success. Middle-market senior housing requires innovative collaboration among architects, developers, and capital partners to align with middle-income price points. Revamping older properties and disciplined new developments are key. Emerging models like active adult rentals and niche communities cater to diverse senior needs. Retail space redevelopments, such as Sophia at Fox Valley, offer integrated senior living solutions, revitalizing underutilized areas. Retail leasing remains strong despite increased bankruptcies, driven by non-merchant categories. Vacancy rates are at 20-year lows, with rents climbing due to high construction costs. The drugstore industry's contraction presents redevelopment opportunities. Open-air shopping centers, especially grocery-anchored ones, are active due to stable fundamentals, offering less volatility in returns compared to other sectors.